Welcome to Griffonomics. Today we are stripping away the filters, the bunny ears, and, the dancing hot dogs to look at a company that has been, well, arguably one of the most misunderstood players in the tech landscape. We are talking about Snap Inc., the parent company of Snapchat. Now, I know exactly where your brain goes when I say Snapchat. You're thinking about teenagers disappearing photos, and maybe that time you accidentally sent a very unflattering selfie to your boss.
It happens to the best of us, though I usually double-check the recipient list these days.
As do I. But here's the thing, and this is why we are doing this deep dive today. If you haven't looked at Snap's financials lately, specifically the Q4 2025 reports, you are operating on old firmware. You are missing one of the most aggressive and frankly surprising financial turnarounds in the tech sector. This isn't just about social media anymore. It is a hard-hitting story about operational discipline.
Absolutely. And to really understand what happened in Q4 2025, you need to latch on to a specific phrase that Snap's management used. They called this year a crucible moment.
Crucible moment.
That sounds dramatic, like something out of a medieval fantasy novel.
It does, but the metaphor is perfect for finance. A crucible is a vessel used for melting and purifying materials at incredibly high heat. You throw everything in, apply pressure and fire, and you burn off the impurities so that only the pure, valuable material remains.
Okay.
That is exactly what happened to Snap in 2025. They applied the heat, melted down their old strategy, and are trying to forge something much stronger.
I can appreciate a good metallurgy metaphor. So our mission today is to unpack this crucible moment. We're going to analyze Snap's fundamental pivot. For years, they were the poster child for growth at all costs, basically trying to get every human with a pulse to download the app. But now they've shifted to profitable growth.
Which is a polite way of saying they decided it was finally time to make actual money. A novel concept in Silicon Valley, I know. But before we get too excited, let's look at the reality. We have a dense stack of sources today, 10K filings, earnings transcripts, analyst notes, and I want to start with the bottom line. Usually when a tech company says they are profitable, there's a giant asterisk next to it. They use adjusted EBITDA or some fuzzy math that ignores stock-based compensation. So give it to me straight. Did they actually make money?
This is a headline that shocked the bears on Wall Street. In Q4 2025, Snap achieved GAAP net income profitability.
Like actual GAAP profit.
No asterisks, no fuzzy math. They posted a profit of $45 million.
$45 million.
Yes. And to put that in context for you, just one quarter prior, in Q3 2025, they posted a net loss of $153 million.
Oh.
So in the span of 3 months, they swung the ship from losing $150 million to making $45 million. That is a massive operational shift.
That is a huge swing. Okay, so they are in the black. But how? Did they just sell a billion more ads? Because revenue was up, right?
Revenue was up, hitting $1.72 billion in Q4, which is a 10% increase year over year. But you can't get to that kind of profit swing just by selling 10% more ads. The real magic and the real pain of the crucible was in the margins. Their gross margin expanded to 59% in the fourth quarter.
59% is healthy.
It is. And management is signaling a path to exceed 60% in 2026. This happened because of something they call cost-to-serve calibration.
Cost-to-serve calibration.
Yeah.
This sounds like corporate speak for we fired people and stopped buying nice coffee.
It's a bit more technical than that. Think about it this way. Every time you send a snap, it costs the company money. Bandwidth, server space, cloud computing costs.
Sure.
For years, Snap treated that infrastructure as a necessary evil. They just paid whatever it cost to keep the app running fast. In 2025, they flipped the script. They started viewing infrastructure as a margin-accretive investment, meaning they stopped spending money on markets and users that don't pay them back. If a server cluster in a specific region costs, say, $1 million to run, but the users in that region only generate $500,000 in ad revenue.
They cut the spend.
They cut the spend. They deliberately reduced marketing and infrastructure costs in places that were effectively money pits.
Which brings us to the part of the report that I found genuinely alarming.
Yeah.
And I want to push back on this turnaround narrative a bit here. Because while the bank account looks better, the user base is shrinking.
It is.
In Q4 2025, daily active users DAUs in North America actually fell. They dropped to 94 million, down from 100 million a year prior. Even global DAUs dipped slightly.
Yeah.
In the social media game, isn't that usually the kiss of death? If you aren't growing, you're dying.
Usually, yes. If this were 2020, the stock would have crashed 50% on that news. But this is where the Crucible logic comes in. This is the North America paradox. You have to look at the why. This wasn't necessarily people getting bored of Snapchat. This was a calculated shedding of what we call empty calories.
Empty calories? You mean users?
I do. Look, imagine you are running a high-end steakhouse. You can fill every single table if you stand out on the street and hand out free burgers. The restaurant will be full, it will look popular, but you are going to go bankrupt because those customers aren't paying for the steak.
Right.
Snap was spending millions on marketing to acquire users who, quite frankly, weren't generating revenue. They stopped buying those users.
So they are trading popularity for profitability.
Exactly. And the proof that this is the right move, at least financially, is in the ARPU. That's average revenue per user.
Okay.
This is the single most important number in the entire report.
Okay, walk me through the spread.
A user in North America generates a massive $10.88 per user in revenue.
Almost $11 per person. That's significant.
It's huge. Now, compare that to the rest of world segment.
Okay.
Those users generate $1.24.
Wow. Okay, I see the math now. One North American user is worth nearly 9 or 10 international users.
Precisely. So if you lose 1 million users in a low-revenue region because you stopped marketing to them, you save the marketing cost, and you lose almost no revenue. The decline in users was a trade-off to protect those 59% margins. They're letting the low-value, empty-calorie growth go so they can focus on maintaining that high-value North American base.
It makes sense on a spreadsheet, but it's still risky. If that North American number keeps dropping, even organically, that $10.88 night multiplier starts to work against them pretty fast.
That is the core risk. You can cut costs to get profitable, but eventually you have to stabilize the user base. You can't shrink your way to greatness forever.
So if they can't just rely on ads from a shrinking user base, they need other ways to make money. And looking at the other revenue line item, it seems like they found one.
They certainly did.
Okay.
While ads are still, 87% of the business, the other category is exploding. It's up 62% year over year to $232 million.
Wow.
And the driver there is subscriptions.
Snapchat Blesba.
The sleeper hit of the year, 24 million subscribers in Q4 2025. That's up 71% from the previous year.
I have to admit, I didn't get it at first. I mean, Twitter, sorry, X has a subscription, YouTube has a subscription, but usually you pay to remove ads. Snapchat Plus doesn't remove ads, does it?
No, it doesn't.
So why are 24 million people paying for it?
It's about status and utility. It offers things like custom app icons, the ability to see who rewatched your story, and exclusive AI tools. But the big one
Let me guess.
is the streak restore.
Ah, the streaks.
If you are a teenager and you have a 500-day streak with your best friend and you lose it because you went camping and lost service, you will pay $3.99 to get that number back.
It sounds trivial.
To us, yes. But to the core user base, that is social currency. And financially, it's massive. This subscription business is approaching a $1 billion annual run rate.
$1 billion a year just for digital badges and streak restores? That is a serious safety net.
It's what we call recession-resistant revenue. Ad markets are volatile. If the economy tanks next month, Ford and Coca-Cola might stop buying ads. But a high schooler isn't going to cancel their $3 subscription because interest rates went up. It stabilizes the entire ship.
And I noticed they're getting clever with other fees, too, like memories.
Memory storage plans. This is brilliant. Snapchatters save thousands of photos and videos to their memories folder. It's basically their life on the cloud. Snap is now charging for storage if you go over a limit, starting at around $1.99 a month.
It's the iCloud model.
Exactly, and it's pure margin. But more importantly, it creates lock-in. You are never going to delete the Snapchat app if it holds the only copy of your photos from the last 5 years.
Okay, so they have the subscriptions humming, but we have to talk about the ads. Because even with subscriptions, ads are still the whale. And the sources mention a technical overhaul called 7-year-old optimization.
Right.
Now, please, explain this to me like I'm 5 years old. Or at least, explain it like I'm not a data scientist.
Yeah.
7-year optimization sounds like a football score. What does it actually mean for a business trying to sell products?
It is a bit nerdy, but it's crucial because it changed how advertisers trust Snap. In the old days, attribution, knowing which ad caused a sale, was fuzzy.
Fuzzy math again.
Right. But 7-0 stands for 7-day click, 0-day view. Here is the scenario. You are scrolling Snapchat on a Tuesday. You see an ad for a cool pair of sneakers. You click it, look at the price, but you don't buy them because you're on the bus.
Okay.
But on Saturday, 4 days later, you go back to that website and buy the sneakers. Under the old model, Snap might not have gotten credit for that sale, or the advertiser wouldn't have seen the connection clearly. The 7-euro optimization means Snap rebuilt their machine learning to track that specifically. This user clicked within the last 7 days, and that led to this purchase.
So they're showing the receipts.
Exactly. They moved from brand awareness, which is just, hey, look at our cool video, to direct response. They are proving that spending $1 on Snap yields $2 in sales, and it worked.
How well?
In-app optimization revenue grew 89% year over year.
That is a huge jump. It sounds like they're finally growing up and playing the same game as Meta and Google. But speaking of growing up, we have to talk about the partnership that came out of left field, the deal with Perplexity.
This is the fascinating one.
For everyone listening, Perplexity is the AI search engine that has been making waves. And the news is that Snap is integrating Perplexity directly into the chat tab. Now, my first thought was, okay, another chatbot, cool. But then I look at the financials of the deal. How much is this partnership worth?
It is staggering. Perplexity will pay Snap approximately $400 million over 1 year, starting in 2026.
$400 million. Just to be inside the app.
Just for the placement.
Why?
Hey,
Why would Perplexity pay $500 million essentially just to hang out in the chat tab?
think about the real estate. The chat tab in Snapchat is the most used part of the app. It's where you talk to your real friends. But historically, for Snap, it's been a dead zone for making money.
Because you can't put ads there.
Exactly. If you and I are texting, and suddenly a banner ad for insurance pops up between our messages, it feels intrusive. It ruins the vibe.
Yeah.
It's what we call ad load constraint. They couldn't monetize their most popular feature.
So Perplexity solves that.
Perfectly. An AI agent fits the interface. It's conversational. You can tag the AI in a chat to answer a question or settle a debate. It doesn't feel like an ad, it feels like a utility.
Right.
So for Snap, this deal creates a high-margin revenue floor. Literally $400 million of pure profit falling to the bottom line without cluttering the interface with junk ads.
And for Perplexity.
They get immediate access to nearly 500 million daily users. They are trying to beat Google and OpenAI. Paying $400 million to be the default smart friend for 500 million people is actually a cheap customer acquisition cost if it works.
It's a win-win. Snap monetizes the unmonetizable, and Perplexity gets an army of users. Okay, so we have the financial turnaround, we have the AI deal, but we can't do a Snap episode without talking about the hardware. The spectacles.
The 5th generation spectacles.
This is where I get skeptical again. They just did all this work to cut costs, fire people, and stop burning money. And yet, they're still pouring millions into developing high-tech augmented reality glasses.
Oh.
Isn't this exactly the kind of science project they were supposed to be canceling?
That is the bear case, yes. Why burn cash on hardware when you are a software company? But you have to view this through the lens of strategy, not just finance. This is Snap's call option on the future of computing.
Explain that.
Right now, Snap lives on iPhone and Android. That means Apple and Google own the land Snap builds on. If Apple changes a privacy setting, like they did a few years ago, Snap loses money.
Right.
If Snap sells a subscription, Apple takes a 30% cut.
The famous Apple tax.
Exactly. Evan Spiegel, Snap's CEO, has been very vocal about this. With the launch of the 5th-gen spectacles in 2026, he took a direct shot at them. He announced that Snap charges no developer tax.
No developer tax. So if I build a game for the spectacles, I keep all the money.
You keep it all. Snap is trying to incentivize creators to build the ecosystem. They're betting that the future isn't looking at a screen in your hand, but looking through lenses on your face.
And what are these things actually like? Are they still those clunky prototypes?
They are getting there. The new ones are standalone, no phone required. They have a 46-degree field of view and run on Snap OS with hand and voice controls. They've even launched Easy Lens, which uses large language models. You can just type, "Make the floor look like lava," and the AI builds the AR effect for you.
That does lower the barrier to entry.
It does, and they have partners like ILM building Star Wars experiences and the Lego Group doing something called Bricktacular. But to your point about burning cash, they actually spun out the spectacles division in Q4.
Ah, clever accounting.
Very. By separating it, they can show the profitability of the core business without the hardware R&D dragging it down too much. But make no mistake, if augmented reality glasses don't catch on, this is a very expensive hobby.
It's a war for the next platform. If they win, they escape Apple. If they lose, well, at least they have the chat app. But speaking of losing, we have to look at the risks. We've painted a pretty rosy picture of this turnaround, but what could derail it?
There are three main threats: regulation, competition, and themselves.
Let's start with regulation. The sources mention Australia.
Yes. In Q4, Snap had to remove 400,000 accounts in Australia.
400,000, why?
Compliance with a new age ban. Governments are cracking down on social media for teens. Snap's user base skews young, so they are right in the crosshairs.
Right.
If the UK, the EU, or the US implement similar strict age verifications, that user count could drop significantly. And this time it wouldn't be empty calories, it would be core users.
And they already paid out $65 million to settle a securities class action, so the lawyers are definitely keeping busy. What about the competition? You can't talk about Snap without talking about the 800-pound gorilla, TikTok.
The TikTok factor is the biggest wildcard in the deck. The volatility of the US TikTok ban status is massive.
It feels like that ban has been pending for years.
It has. But here's the binary outcome. If TikTok gets banned in the US, Snap likely inherits a massive chunk of ad dollars and user time. It would be a windfall. But if TikTok stays, the war for attention continues. And TikTok is brutal competition. Snap has to fight for every single minute of user time.
And the third risk, you said themselves.
The simple Snapchat redesign. They are consolidating the app into 3 tabs: chat, camera, and for you.
Merging stories and Spotlight.
Yes. And historically, every time Snap changes its design, the user base revolts. Users hate muscle memory changes. If they roll this out and it annoys that core North American user, the one worth $10.88, and they stop opening the app, the whole profitability model collapses.
It's a high wire act.
Yeah.
They need to simplify the app to attract new, maybe older users.
Yeah.
But if they alienate the teens who live on the app, they're toast.
Precisely. They are betting they can retrain the user base without losing them.
So we've covered a lot. We've got the $45 million GAAP profit, the Crucible restructuring, the drop in users, the $400 million Perplexity infusion, and the sci-fi glasses. When you synthesize all of this, where do we land? Is this a company that's back from the dead?
Based on all the sources, the investment outlook is best described as a high-risk turnaround buy. But I emphasize the word speculative.
Why speculative? They're making money now.
They are, and that's impressive. Snap has successfully manufactured profitability. They cut costs, they calibrated their spend, they built a subscription engine that shows incredible discipline. But financial engineering has a limit.
You can't cut your way to growth.
Exactly. The 2026 bull case depends entirely on stabilizing that high-value North American user base. The Perplexity deal buys them time and cash, and the spectacles are a lottery ticket for the future. But the core business selling ads to Americans needs to hold the line. If that user number drops again next quarter, the market might lose faith that this is sustainable.
So the adult supervision has arrived, they balanced the checkbook, but now they actually have to win the popularity contest again.
That is the perfect way to put it. They've survived the Crucible, but now they have to perform.
Yeah. Well, it's going to be a fascinating year to watch. Snap is burning off the impurities to find the gold underneath, but let's hope they don't melt the pot in the process.
Indeed.
Risk defined, portfolio protected.